Ain't no crying in real estate. Multifamily investors, Fed just made the biggest liquidity move of the year. And if you understand what this really signals, you're already ahead of 90% of the market. This week, we're talking about how the Federal Reserve officially ended quantitative tightening on December 1st, 2025, marking the first major shift in liquidity conditions in nearly 3 years. And here, really why it matters to you. Liquidity drives credit markets, and credit markets drive interest rates, refi windows, and cap rate behavior. If you miss this inflection point, you'll be reacting instead of positioning. I'm Noel Parnell, co-fund manager of Invictus Elite Capital Group, and welcome to the Ain't No Crying in Real Estate show on the Profit Door. Today, I'm breaking down the reasons behind ending QT actually means for multifamily housing, lending, valuations, and your strategy going into 2026. The Federal Reserve ended QT after shrinking its balance sheet by roughly $2.4 trillion since June 2022. That's a massive reduction. When they stopped it, it wasn't because they felt like it. It was because the bank reserves were getting tight. QT ending means the Fed is no longer letting assets roll off without replacement. Instead, they're reinvesting principal payments to keep the balance sheet steady around $6.6 trillion. So what does that mean? Well, in plain English, they stopped draining liquidity out of the financial system. We reached a point where pulling more liquidity could create strain or instability. Now, here's the part the media isn't talking about right now. Right after QT ended, the Fed executed a $13.5 billion repo operation, one of the largest since the pandemic. Repos are used when the system needs fast, cheap liquidity. This is a smoke signal. Short-term funding demand was rising, and the Fed didn't want the system stressed. This really is telling us that banks needed support, liquidity needed stabilizing, and credit markets were at a pressure point. The Fed acted before anything broke. This affects real estate more than people realize. As liquidity affects debt spreads. Debt spreads affect interest rates affect DSCR affects valuations and LTV. When the Fed stabilizes liquidity, it cools volatility. That means lenders get more comfortable, refi windows become more realistic, cap rates they may stop expanding, credit availability can improve going into 2026. So we're not going back to QE, but the bleeding has stopped. So multifamily investors, hear what that means to you and the shift that you need to just prepare for. Rate cuts aren't the first signal, liquidity is. Your refinance strategy might open quicker than expected. We don't have a ball, but maybe. Loan assumptions and bridge to perm strategies gain breathing room. Cap rate expansion may slow as financing markets stabilize. It's a green light to start preparing your acquisitions and refi pipeline. Now, this is what smart investors do. They move when liquidity moves, not when headline changes. So, here's the bottom line. QT ending is one of the clearest signs that we're shifting out of the restrictive monetary phase. It doesn't magically fix the market, but it does change the trajectory of change the trajectory. Liquidity has stopped tightening, and funding markets have breathing room. And in real estate, especially in multifamily, that's often the quiet beginning of the next opportunity cycle. So here's your FYI. Stay sharp, stay strategic, and remember, there ain't no crying in real estate.